we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Darshan Mehta and you're watching Indian Open. Let's go straight to the headlines. European Central Bank will halt its 2.6 trillion euro bond buying program this month, ending almost 4 years of quantitative easing. Reserve Bank of India board will meet today under the new governor Shrikant. The 18-member board is expected to discuss a proposal for closer supervision of the central bank. In a relief for Airtel and Vodafone Idea, the Telecom Appellate Tribunal set aside TRAI's predatory pricing guidelines. The placed restriction is on all older operators but excluded Reliance Jio. The Supreme Court verdict is expected today on pleas seeking a court-mentioned investigation into India's Rafale fighter deal with France. After a two-day impasse, the Congress chose Kamal Nath as the Chief Minister of Madhya Pradesh. The party will pick CMs for Rajasthan and Chhattisgarh today. Okay, let's take a look at what's happening as far as the market is concerned and what the trade setup is currently. Let's take a look at the global cues, and most of the cues that came in from the global markets were muted. Asia is down in trade. The Nikkei's managed to move down by almost 2% in trade. Most of the other markets like Hong Kong and Shanghai are too bleeding in trade. The SGX Nifty, which was trading with a positive bias, has now slipped in even further, coming close to the 10,750 mark. So expect a gap down opening in trade today. Crude managed to rally over 3% overnight, and even in morning trade has continued to do well, while Chinese commodity continue to rally. The other traction is the economic data. What should you watch out in trade today? Firstly, you need to watch out the RBI board meet that will happen today. A lot of emphasis will be placed on the PSU banks today, so watch out for the Nifty Bank and the Nifty PSU Bank Index. And the November WPI number will come out. The Bloomberg estimate is 4.64 as per their consensus. What do you watch out for? Some stocks that will be in focus. First of all, Motherson Sumi. Now, Reuters has come out with a report indicating that it's in early talks with a Germany-based auto anchor maker Leoni. Leoni, remember, ended up 17% post this news that came out on the German exchanges. The deal is expected to be worth $1.14 billion. So it's mainly acquiring of Leoni and then merging it with itself, given the fact that there is a slowdown in the auto anchor industry. So Motherson is the first one. Secondly, watch out for Indian Oil Corporation. A buyback at a 9% premium and a dividend that was given, which means a dividend yield of almost 5%. So that is something that you need to watch out for. Citi has initiated coverage on United Breweries with a target price of 1550. The potential upside is 23%. What Citi says is that the beer market in India is at a nascent stage, and the socio-economic trends do indicate that there will be significant pickup that will happen here. Economic Times reports that the GST on a meeting on the 22nd is scheduled on the 22nd, and there is a potential that the GST on cement may be cut. So watch out for the cement counters. Ultratech is the largest one, but watch out for the smaller companies also that will be there in focus. Analyst takeaways. JSW Steel took analysts to their Karnataka plant and explained what the rationale was. What they say is that the expansion for the plant is on track and it is expected to be commissioned by March 2020. And on the NMDC iron ore mine, they expect minimal impact of the Karnataka mine closure. Indian Energy Exchange will be in focus. They will consider a buyback on December 20th. And finally, two companies which missed the bus as far as earnings were concerned. Not the largest of company, but nevertheless, they still will come out with numbers today. So watch out for Quality and IL&FS Investment Managers, which will report numbers today. But on first word today, fuel consumption by airlines indicate that passenger growth may have slowed down in November. Despite the festive season, Soumit Sarkar will join us to explain why this has happened. With lower raw material prices and price hikes, soap manufacturers will have much more to cheer about. Yatin Mota will give us the margin picture. Then we look at the widening market cap divide between HUL and ITC and what is causing it, and I will speak about that. And Welspun Corp is one of the best performers on the metal index this year. Nikki Mirchandani tells us what's aiding the rally for the counter. But let's start with the first story. Fuel burned by airlines in India grew at its slowest pace since the beginning of the year in November. Does that indicate continued slowdown in air traffic growth even as the festive season is going on? Soumit Sarkar is standing by with the analysis. Soumit, what's the source for all this data and what does this data indicate?
Well, for the ATF consumption data, PPAC is the source, and that data is suggesting that the passenger growth could have been muted in the month of November. Now, if you see in the month of November 2018, jet fuel consumption grew only 5% compared to last year. That is the slowest growth rate seen in 2018. Now, a lot of oil and gas analysts were surprised by this number because that number was expected to be higher in the month of November because that was the holiday month. So the passenger growth was expected to be higher, which would have led to higher fuel consumption. From an average growth rate of around 10% in the first 10 months of 2018, the consumption growth rate has fallen to around 5% in the month of November. Now, this could be on the back of two possible reasons. First is the lower passenger growth, and second could be the fuel-efficient airlines. Now, fuel-efficient aircraft could not contribute much to that because if you see still a lot of airlines have a lot of older aircraft, and so fuel-efficient aircraft could not be the major reason for this fall in ATF consumption. So the only reason that I could conclude, and also analysts to whom I spoke to agreed with this, could be the muted passenger growth number in the month of November, which would have led to this this muted growth in the ATF consumption in the month of November. So if you see Ashish Shah, to whom I spoke to, and is an aviation analyst with IDFC Securities, now he agreed to this, and is accepting that the passenger growth rate could be muted in the month of November because the ATF consumption was lower. Another analyst to whom I spoke to suggested that the airfares were higher by around 1,500 rupees to 2,000 rupees compared to the Q2 prices, because of which the passenger growth could have been muted, which led to an ATF consumption growth muted in the month of November. While Hetal Gandhi of CRISIL, now she blames the lower consumption to the financial constraints of the airline companies, which could have led to lower consumption in the month of November. But she's also accepting that the passenger growth rate would be only marginally higher compared to October month. Now, if you see in the October month, the passenger growth rate was only 13%, which was the lowest in the last 15 months, which says that in the month of November also the passenger growth could be muted. Now, in the last 3 years, if you see, India on an average has seen a passenger growth rate of around 20%. From that, it has now come down to 15%. So this will definitely impact the airline companies because domestic airline companies have already placed large aircraft orders. Among them, Indigo could be impacted the most because the company not only aims to grow its capacity by nearly 30% compared to last year, but has also firm aircraft orders of more than 400. So that could be the company that could be impacted the most because they're looking to increase their capacity by 30% every year, and a growth rate of 15% on passenger growth rate will obviously have some impact on the company.
Soumit, I just have a couple of questions. First of all, one of the reasons could be potentially that there could be more grounding of airlines. Has any of the airlines communicated this to you? And secondly, could the festive season being shifted to October because Diwali was during October, that could be a potential reason that November could be lackluster? So
actually Diwali this year was in November. Last year it was in October. So the base for the passenger growth would be low, but still they're expecting the passenger growth to be low. So that's one concern for the airline industry because they were seeing a growth rate of around 20%, and if it comes down to around 15% now, so that will be one concern. Second, when it comes to grounding in the month of November, we did not have any such reports coming in of grounding of aircraft. So that was not the reason that could have left to lead to this lower consumption of ATF in the month of November.
Okay, many thanks for that, Soumit, and we'll certainly watch out what happens in December, whether the tide changes or no. But consumer staple makers are likely to get a margin boost amid benign raw material prices. That is palm oil, which is a key raw material in many personal and home care products. And that has seen a sharp drop this year. What's more, most FMCG companies have hiked prices on top of that. Yatin Mutta is standing by with the margin picture. Yatin, what's the analysis?
Darshan, if you look at palm oil and crude oil, these are the two raw materials whose derivatives are used in soap manufacturing as well as manufacturing of various personal care products. Now, if you look at the palm fatty acid, or basically the palm oil product, and if you can see it on your screen, there is a sharp correction of almost 47% which has come in for this particular commodity, and more importantly, it is used in manufacturing of soap, candles and cosmetics. Also, it goes into, various confectionery and bakery products. So a lot of these FMCG companies whose major portion of revenues comes in from personal care segment or, food could, significantly benefit. In fact, if you look at the crude prices also, the crude palm oil prices are also down nearly 26%, which is again used in soap manufacturing. So two key raw materials, including crude oil, which is again one commodity which has taken a beating. Now, if you look at FMCG companies, most of the FMCG companies last quarter as well as in the last few days have increased product prices. Not only that, this price increase will help them improve the revenues and margin profitability for the non-food FMCG business. Now, if you talk about companies like HUL, ITC and Godrej Consumer, they have a lot of these famous or popular soap brands, including Dove, Lifebuoy, Lux for HUL, ITC does Fiamma de Villes, and also we have Godrej Consumer, which manufactures Synthol soap. So all of these companies are potential beneficiaries of these kind of raw materials coming down in the marketplace. Now, instead of cutting prices because of the deflation in the input cost, we have these companies which have recently increased the soap prices. So for example, HUL increased the Lifebuoy total prices by nearly 5.5 to 6% odd range. Similar is the case with Lux Sandler and Cream Soap. This is basically research by Access Capital. If you also look at Godrej Consumer, Synthol prices are up nearly 5%, and for that of lower end brands like Liril and Lux Creamy White, the price hike has been 2%. So given the fact that the raw material prices are coming down and FMCG companies are increasing pricing, on the contrary, it will clearly aid the overall margin picture. Now, if you look at the advantage what all of these companies have, HUL derives nearly 47% of their revenues from the personal care segment. Also, ITC derives nearly 9%. Of course, the major portion is cigarette business, but still 9% of their total revenues comes in from the consumer care and personal care segment. And finally, we have Godrej Consumer Products, wherein nearly 18 to 20% of their total revenues comes in from the overall personal care segment, according to the FY18 annual report filing. So probably all of these FMCG companies are to gain here, given the fact that raw material prices as well as input costs are coming down significantly.
And no doubt, Yatin, HUL trading at record highs, it's beating ITC hollow, and we'll talk about that later. But nevertheless, most of the FMCG companies are continuing to do well with strong volume growth and margin expansion. Thank you so much for that. Let's talk about two companies in the FMCG space. HUL and ITC are the largest consumer staple makers in the country by market capitalization. But HUL has widened its lead over ITC consistently this year. Now, let's first take a look at how the market cap of both these companies has panned out. If you take a look at from almost 3 or 4 years, it was ITC which always had the larger market cap, and the gap always continued. And probably around last year, the gap was the widest when ITC outperformed and HUL didn't. But over the past few months, we've seen that the tide has actually turned. While they were neck and neck for most of the part of the year, this time around the gap has widened. So HUL market cap has gone above the 4 lakh crore mark. ITC still comes in and has dropped to close to 3.5 lakh crore. So the market cap is moved out. Now let's take a comparison of what differentiates these two companies and on what parameters. First of all, HUL has moved up 36% on a YTD basis compared to just 4% for ITC. So ITC has been a marked underperformer while HUL is trading at record highs. Look at the buy calls. Buy calls, 54% of the analysts that track HUL as per the Bloomberg estimates have a buy rating, while it's an 85% for ITC. Now the potential upside is limited for HUL. Most of the analysts have a target price which is below what the current market price is, but the potential for ITC is much higher. 23%. Look at the multiple here. HUL trades at record highs on a multiple of 56 times, while ITC trades at a multiple of 24 times. So ITC is one of the by far one of the cheapest stocks in the consumption space. Even if you look at the other parameters, where it said revenues of ITC are almost close to 3,000 crores more than what HUL does this is the first half year earning, and the margin almost 23% is what HUL delivers, while ITC delivers 38%. Now, if I put this table in front of you, you would say on all parameters, ITC is far more superior in terms of the financials, in terms of the return ratio, in terms of the valuation, in terms of what analysts are saying. But yet, HUL continues to do much better and still continues to rise in further. And why does ITC continue to fall? Now we'll break this up. What is aiding HUL? The biggest important thing is that there is significant growth in the FMCG space. The GSK consumer acquisition is extremely positive for growth. Most of the analysts that wrote in on this post this deal indicated it's positive. A lot of analysts did manage to upgrade the counter. The distribution network is extremely strong. The health food drink category which it acquired from GSK is actually underpenetrated. So with a strong distribution network, they will be able to push up Horlicks and the other brands that is there. Apart from it, the volume growth is very, very strong. Now remember, HUL does not operate on a small base. The base is growing, but the volume growth is almost in double digits every quarter. So that's something that is clearly working for HUL. Now flip it, what is not working for ITC? First of all, there is high dependence on the tobacco business. 80% or probably little more than that of their profit and their margins comes in from the cigarette division. The taxation risk always persists as far as ITC is concerned, because still there is no clarity on what will happen as far as the GST is concerned, and that is there. The FMCG business that ITC does, even though it is EBITDA break-even, it still doesn't have the distribution reach, and it's always into investment phase. So the money that they are generating there is again plowed back in the business. So that is not seen. And apart from it, if you're looking at the other businesses, the paper business, the agri business, all of them haven't contributed much. They are minuscule. They are probably even less than 5% of the total revenue. So the dependence on cigarette is extremely high. And even if you look globally, tobacco as a theme is not seeing traction. You take a look at the global cigarette counters, tobacco counters, the traction is not there. FIIs have not putting their money, or investors are not putting money into this. And one of the key risks again is it's a sin stock as per what a lot of HNIs and a lot of funds say in India. It's a sin stock, so a lot of people are opposed to investing in ITC. So on paper, ITC far superior than HUL on all parameters, but the truth in reality is different. HUL continues to outperform while ITC continues to lag in the market. So that's the word on the consumption space. And finally, we move to the metal and infra space. Welspun Corp is one of the best performing stocks on the metal index this year. In fact, it is one of the only two stocks that have gained. So what does Welspun have that others don't? Nikki Mirchandani is standing by to tell us just that.
Hi Darshan. Finalization of US duties for the large diameter welded pipes is clearly a negative development for all the pipe manufacturers, but that clearly hasn't been the case for Welspun Corp, which has a neck-and-neck race with JSW Steel in terms of the performance that we have. At least for a year now, the stock seems to be gaining at around the 14% as compared 10% as compared to the 14% seen by JSW Steel. And if you look at the 6-monthly basis, the company is the sole performer that we have in terms of the performance. So what's really fueling the rally? Let's straight away get on to it. US facility. The company has a US facility and does manufacture large welded diameter pipes out there, which helps them benefit from the tariffs which have been levied on the Indian manufacturers. Let's look at the frequency. EDSOP pipe manufacturing is around 350,000 million ton, and the high frequency induction pipes manufacturing is around 175,000. Besides that, it benefits from the US tariff because of the increased capacity utilization that this plant can see on account of the incremental demand towards this company. Second point that's really working well for the favor in the company, well, the net debt of the company has come down significantly lower in this last 1 year. If you'd see, from 1,005 crore, it's come down to 395 crore, thereby improving the debt to equity ratio of the company. Apart from that, we are also looking at a healthy order book, which is almost at an all-time high level, which is buoyed by the demand that we've seen across the markets for this company. Now stands at 1,721 crore that we've seen in Q3 FY19 as compared to a figure of around 700 crore that we saw back in Q2 FY18.
So Nikki, but it can't be all good. What's the bear case scenario for Welspun Corp, and what are the risks that are facing the company?
Sure. Actually, a couple of points that I'd like to talk about in terms of the risk that the company would be facing. Let's start off with the lower capacity utilization level. Right now, it stands at 45%, has moved up from 39%, but still at 45% remains significantly lower. Though the management, however, in its note while the time of a con call post the earnings suggested that it does plan to increase the utilization level by at least a 15%. Second point is the poor return profile so far that the company has seen. If you look at the first 3 years, that is 2014 onwards to 2016, the return of equity is actually a negative for the shareholders, clearly not making out money on there. But then if you look at 2017 and 2018 figure, you would see a higher return on equity, but then that seems to be diminished or receded from the level that we've seen from 2017. And the last point that the company also highlights and has the management has highlighted in the annual report, they've spoken much about the execution or the delayed risk that the company can face from the execution of its large projects. And also, Darshan, I'd like to highlight a little bit about the valuations of the company right now. Seems to be fairly decent. 5-year average, almost the stock is trading out there at 5.7 times EV to EBITDA.
Okay, many thanks for that, Nikki. We'll certainly watch out for. And Shaktikanta Das's first test comes today when the central bank board meets is due today. The government is expected to push for tighter supervision of the RBI, including setting up committees to have an oversight on various functions. Bloomberg Heidi Stroud spoke to Sonal Verma of Nomura earlier, and she believes that the regulatory policies under Shaktikanta Das's governorship will be much more sympathetic to the government's argument. Here's a slice of that conversation.
I think, as far as the central bank independence is concerned, that is something that we will see over a period of time. We've had a number of finance ministry bureaucrats and their credibility and independence was initially questioned, but RBI as an institution has managed to retain the credibility and independence over a period of time. So I think one should not prejudge. But specifically on this new governor, I think there are two aspects. One is the monetary policy aspect, and second is the regulatory policy aspect. As far as the monetary policy aspect is concerned, the decisions are now made by the Monetary Policy Committee. So the new governor, we do think, has a neutral to a dovish bias on monetary policy, but the decision ultimately is driven by fundamentals, and that does point to a more accommodative rate outlook. But as far as the regulatory policies are concerned, the governor does play a fairly important role. And on that aspect, issues related to the banking sector, issues related to liquidity, we do think that the new governor will be more accommodative.
Yeah, I mean, they've managed to maintain independence, but in the meanwhile, they've lost 2 central bank governors essentially for this reason, right? Do you expect that the pressure from the government will continue?
Well, I think on the banking side, to be fair, both the Reserve Bank and the government have equally important points to make. The economy has been hit by, I would say, a credit shock. The banking system has been under pressure for many years now, and the non-banking sector, which was sort of filling in the void that was left by the banking sector, has also been hit with a shock. So you have an economy which is sort of a credit-driven economy, which is seeing significant tightening in financial conditions and credit conditions. So the job, of course, of monetary policy authorities has to be to ensure that policies are more counter-cyclical rather than pro-cyclical. And apart from regulatory policies, if the system as a whole requires more liquidity, then more liquidity needs to be provided. So I don't think it is fair, to say that one is right, one is wrong. I think both have an equally important point to make. We need to address the near-term concerns. We need to ensure that there is no credit risk event in the economy because of lack of liquidity. But at the same time, without diluting medium-term financial stability, of course, we do not want to raise medium-term financial stability risks.
Those fundamentals that you mentioned that could actually support a dovish tilt, this GTV chart on the Bloomberg showing inflation easing, boosting the case for easier rate policy. So what's the outlook for inflation and price pressures going forward into the new year, especially when you have oil prices fluctuating?
You're right. I mean, the outlook does look quite benign, as the new governor acknowledged. Oil prices have come off. Food prices, in our view, are going to stay quite low because a lot of the cyclical forces do suggest that. And I think the one concern that we have seen in 2018 has been very high core inflation. But given the demand side of the economy, which we think growth is going to moderate to 6.5% in the next 6 to 9 months, even the demand side inflationary pressure should come off. So we think inflation is going to stay around 4%, which is the Reserve Bank's medium-term target. So the real rates right now in India are quite high, and therefore, a cut in the RBI's repo rate. But before that, a change in the stance back to neutral is what we are expecting.
The state election results really were not as great as Prime Minister Modi's party had expected. What impact will that have on economic policy next year?
Well, there isn't much time left, honestly, and the government doesn't have enough money. They're already struggling on the fiscal front. Clearly, from the BJP's perspective, the question is whether something needs to be done on the rural economy to sort of assuage the rural voters. But that essentially means sort of a quick fix. There are talks of a farm loan waiver. Like I said, the government does not have the money, but an announcement on that front could be there, but I think that would endanger macro risks. But I think more than that, the state election results have really enthused the opposition, and a grand coalition led by the Congress and a lot of disparate regional parties is something that we will see. So we do think that political uncertainty will rise, and from an economic perspective, that also means weaker investment, and that's also one of the reasons why we think growth is going to slow down.
Okay, that brings us to the end of First Word, but a lot more lined up on Indian Open as we discuss markets and macros with Pradip Shah of IndAsia Fund Advisors, and a special conversation with Saugata Gupta of Marico on the long-term outlook for the FMCG sector at 9:30 a.m. But after this break, we will take a full tilt towards the day's trade. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Welcome back. You're watching Indian Open. Let's see how the Asian markets are faring at this point of time. While most of the global markets were muted in trade, there seems to be cuts as far as the Asian market is concerned. It's gone even higher for the Nikkei. Nikkei is down 1.7%. The Shanghai is down close to 0.8%. And the Hong Kong markets are down almost 1.5%. Let's take a look at what the SGX Nifty is indicating at this point of time. And that indicates a negative outlook. Yesterday, also remember, we corrected significantly from the day's high. And we saw traction that was lost in the market, and the Nifty especially. What's happening as far as our positions are concerned? We can see that the Nifty futures yesterday saw fresh long positions that were taken. Open interest build-up was absolutely negligible, 0.1% in open interest build-up. A little bit of short covering was seen on the Nifty Bank. Open interest was down almost 9%, and the Nifty Bank managed to inch in at almost 0.6%, given the fact that there was traction that was seen in HDFC Bank as well as Kotak Mahindra Bank. Where are positions taken? We are currently at the 10,800 mark in trade, and that's where majority of the positions are being taken at this point of time. You could see that both call writers and put writers are active at levels of 10,800. The 11,000 seems to be the where call writers are extremely active, so that's the resistance for the market. And at lower levels, 10,500 is where put writers are very, very active in trade. What happened in trade yesterday was that put writers became aggressive from 10,000 right up to levels of 10,800, and call writers are active at 10,900 to 11,000 level. So it looks like it's slightly a broad range market that we're looking at this point of time. As far as the stocks in the F&O band is concerned, the two stocks continue to remain. Adani Enterprises and Adani Power continue to remain in the F&O band. The PCR for the Nifty managed to rise, but not so much for the Nifty Bank. That managed to cool off from 1.44 to 1.25. Couple of stocks that you need to watch out. High open interest build-up was seen in PC Jewellers. Open interest build-up of 15% on the long side. But apart from it, the other counters like Chola, Godrej, Berger Paints and Container Corp, all of them saw decent open interest build-up, but they were rather flat in trade. In terms of stocks which saw open interest decline, watching particularly for the banks, you had Bank of India and Indian Bank saw short covering that came in. ACC obviously reacted positively to the capacity expansion news that came out, so there was short covering was seen, and ACC now moves in above the 1500 level. So that's all the stocks that you need to watch. That's all the F&O cues that you need to watch out for. But lots of stocks that we need to watch out for in today. So Yash will join us with all the stocks that you need to watch out for. JSW Steel had an interesting analyst meet. In fact, they called all the analysts to their Karnataka plant and explained to them what the scenario going ahead. And a couple of interesting brokerage note, especially the City note on UB, is something that Somit will address. So good morning to all of you. Yash, I'll start with you. Which are the important stocks to watch today?
I'll start with Indian Oil Corporation, and they came out with their details for the share buyback when they are going to buy back close to 3% of the outstanding equity shares at a price of about 149 rupees a piece, which is at a premium of 9% to its Thursday's closing price. That apart, they would also be paying an interim dividend of 6.75 rupees per share. That apart, watch out for Motherson Sumi. Now, this is on the back of a Reuters report which states that the company is in early stage talks with German-based company Leoni for the likely merger or acquisition, with the deal likely to be worth in excess of $1 billion. In a big relief to telecom players Bharti Airtel and Vodafone Idea, the telecom dispute settlement and appellate tribunal has set aside the predatory pricing regulations which the TRI had come out with the order back in February. Dilip Buildcon will be in focus after the subsidiary of the company achieved a financial closure for one of its highway projects. NCLT approval coming in for Capital First for its merger with IDFC Bank, so watch out for that one. And a key multi that we are watching out is in Max Financial, wherein New York Life Insurance has bought close to 2% stake in the company, whereas the promoters have sold out the similar number of shares.
Okay, we'll certainly watch out for all those counters. Nikki, the JSW Steel analyst meet, anything interesting or new that they said in the analyst meet?
So a couple of analysts met the plant visit, went to the plant at Vijayanagar, and they found the expansions to be on track, pretty much coming in line with what the expectation was. And they highlighted few points where they suggested that JSW Steel is going to be increasing the capacity at Vijayanagar from 12 MT to 13 MTP, and this along with downstream expansion would cost them a capex of around 100 billion rupees. Apart from that, they also suggested the expansion of Dolvi facility would which again was announced from 5 MTP to 10 MTP, almost doubling of that. And this expansion seems to be on track and has to be completed, would be completed by March 2020, in line with the targets that the company has set out. Further, it also suggested that the company right now has enough of land for further expansion of capacity from 13 million ton to 18 million ton. Apart from that, they spoke a little bit about their raw material, where they said that the company is going to be setting up a 1.5 MTPA coke ovens. Apart from that, they extensively spoke about iron ore mines, where they say that they do not see any risk coming out from NMDC Donimalai iron ore mine, even if that shuts. In fact, they said they suggested that they have enough iron ore right now, and they could benefit from the increase in Karnataka iron ore mining cap from 30 to 35 MTPA.
Okay, many thanks. We'll watch out for JSW Steel and a couple of interesting brokerages coming out. What do you have for us, Somit?
The first one is on United Breweries, as you just mentioned, and that has come out from Citi, who has initiated coverage on the stock with a buy rating and a target price of 1550. Now, according to the brokerage, in the last decade, beer volume growth have exceeded that of spirit, and going forward also the brokerage sees more value growth for beer than when compared to spirit. That is because the market is small for beer, and there's a lot of growth potential for the beer market going forward, according to the brokerage. Now, the brokerage is expecting the industry volumes to grow at a compounded annual growth rate of 8% over the medium term. Now, for United Breweries, the brokerage says that it has a strong competitive advantage in form of its dominant market share and 21 owned breweries. Along with this, the company's stride towards premiumization also provides a big opportunity for United Breweries going forward, according to the brokerage. Lastly, the brokerage is expecting the company's EPS to grow at a compounded annual growth rate of 26% over FY18 to FY21, which is the highest growth rate among its peers. The second note that we have is on L&T, where Deutsche Bank has maintained its buy rating but has cut down the target price to 1620 from 1650. Now, according to the brokerage, new project announcements have fallen sharply, which would have a bearing on the new order inflows of L&T for the next 4 quarters. And on the back of this, the brokerage has cut its estimates for order inflow and the target price marginally. Now, the brokerage also adds that the near to medium term order inflow uncertainty as well as political stability uncertainty would be an overhang on the stock. However, despite this, the brokerage has maintained its buy rating on the back of reasonable valuations and a likelihood of recovery in private capital expenditure post the election period.
Okay, so we'll watch out for all those counters in trade today. I'm joined by Siddhartha Khemka of Motilal Oswal. Good morning, Siddhartha. In such markets, firstly, let's start with what are you advising clients? Are you telling them to start investing? Are you cautioning them? What exactly is your stance?
Yeah, good morning, Darshan. So we have seen quite a volatile sessions in the last few months. However, there was a big overhang of the state elections, because of which a lot of clients were wary of taking fresh positions, at least from a positional or a long-term perspective. So that overhang is now over. We had seen the twin impacts of the crude oil as well as the INR, which was also impacting our economy, which has now cooled off and had turned positive. However, the market, because of the elections, were not factoring to that extent. So once we saw that election getting over, whatever be the results, market have started moving positively. So we had suggested to selectively start looking at picking up good quality long-term stocks mainly from the last week and starting off this week. So that is where our overall advice is. Markets would continue to remain volatile. However, this is an opportunity for investors to start picking up good quality, high earning visibility sectors. So if you see our view on the market, we continue to remain a little more positive, or we suggest still to stick to large caps, given that the volatility is likely to continue when we enter into 2019. However, there are pockets of opportunities in the mid cap as well. In terms of sectors, we have been clearly positive on the corporate lenders for quite some time, which has played well for us. We are now selectively also looking at some of the cap goods and infra names where we believe there are green shoots of recovery. The execution has started picking up, and once we are well past the 2019 general elections, we would see again order inflows coming up, and flowing into these sectors.
Care to be stock specific, Siddhartha? Which are these stocks that find place among your high conviction list?
So in the high conviction, if you see from the corporate lenders, the ICICI and Axis Bank figures among our top picks. Some of the consumer names which we continue to believe will do well, although given their valuations, the upside could be limited. However, we still continue to have a positive view on them. Stocks names like Hindustan Unilever, Britannia. Some pockets of opportunities in the auto sector like Maruti and Exide in the mid-cap space. Also looking at the election results, we believe there could be some push towards the rural agri theme by the government before the election. So some of the agri-related stocks could also see some interest in the market. So stocks like Escorts, M&M could do well. In the capital goods, that's a theme which we believe should play out in 2019. The stocks that we like there are capital goods and infra together. So the stocks that we like there are L&T, Cummins and Thermax.
Okay, lots of stocks. Let's talk about some of the stocks. Firstly, what's your view on Motherson Sumi? That's been a marked underperformer. Now, news also coming in from Reuters that they're looking in for a $1 billion euro acquisition in Europe. Do you like Motherson Sumi? Are you recommending that to your clients?
If you see, although the long term Motherson has done well, however, in the recent times there have been issues. So issues right from so 2 years back we had seen the Volkswagen issue and the recent the Brexit and all those things. Also, you would see that those are things which have been impacting the growth of the company. However, over a longer period, we have seen the company's management quality has done well. They have mostly overachieved their 5-year visions and targets. They have also taken the help of a lot of
just hold on, Siddhartha. Raghuram Rajan is speaking at one of the events. We'll cut across to him and I'll head back to you.
What is deficient in terms of education and skilling? What is deficient in terms of healthcare? How healthy is our labor force, and how healthy are our children today, and how likely is it that they will be able to participate going forward? So we need to improve capabilities, we need to improve our environment and our relationship with it, and more broadly, as global citizens, we should lead the way in our approach towards climate change rather than follow behind. What we have done is brought all this together in a set of proposals. As I said, we are 13 concerned economists, and this is all done voluntarily and on our personal time. There are detailed notes we should go into. So with that as a preamble, what I want to do is go down the list of participants, give them some time to talk about their views, and then we open up to questions. Again, do think about your questions as we go along, but please don't ask questions about the issue of the day. Let's talk about the issues that the committee has talked about. Let me start with Rohini Pandey from the left, and we'll move down this side.
Okay, that was former RBI Governor Raghuram Rajan speaking. Let's get back to Siddhartha. Siddhartha, sorry, I had to interrupt you on Motherson Sumi. Yes, you can continue on your discussion.
Yeah, so I was saying that the management track record over the last 15-20 years has been very good, and they have occasionally, actually regularly taken the help of inorganic growth opportunities to achieve their 5-year visions. So as you said, we are hearing that they are looking to acquire a German company which would again help them in achieving their 2020 targets. The stock has corrected, and these valuations we feel that purely from a long term, so the near term there could be issues relating to the Brexit and stuff like that, and the numbers may not be that good, but investors looking from at least more than a year, so 1 to 2 years, can definitely look at Motherson. We definitely have a buy rating on the stock, and we'll review post the company announces the latest acquisition.
Okay, Siddhartha, what about Indian Oil? Yesterday it announced a buyback, a dividend. It'll cost them close to 12,000 crore, pretty much wipe off the cash of the books. But if someone wants to invest in IOC, and let's also take in the other oil marketing companies, is it a wise thing to do, or you should avoid this space?
So, see, overall, we see that the oil prices which were inching up and were impacting the overall economy, the government came in and restarted the so-called subsidy sharing burden on the oil marketing companies. However, we have again seen that oil prices now cooling off, the OPEC deciding to cut supply much lower than what the market was expecting. So 1 to 1.5 million barrels a day cut compared to a 3 million barrels per day expectation. So that we believe that the crude oil prices would now remain stable. The rupee has also now cooled off. So given this entire thing and the valuations at which these oil marketing companies are, we believe some of them could do well from here. Now the new development of buyback, at least for Indian Oil. So Indian Oil was our preferred pick in the overall OMC space, given the free cash flow generation, the capex that is mostly over. So now this new development of the cash getting distributed as buyback to the shareholders, we'll have to review, but nonetheless from a longer term perspective, there is a case to invest into oil marketing companies at these levels.
Okay, so that just hold on. Gaurav Bissa of LKP Securities joins us on the show. Good morning, Gaurav. What's the trend you're looking on the Nifty? Has it topped out? Yesterday it came off the day's high. Today it's looking to go looking weak. What's the trend that you're seeing?
Good morning. I don't think there's a dent in the trend to speak of right now. 2 or 3 aspects. So one, we have seen good amount of addition happening in Nifty as well as Bank Nifty. Good amount of writing happening in out-of-the-money put options, predominantly 10,600 to 10,400 put options. That again is a good sign. 10,750, 760 has a very strong support. The 200 DMA, 50 weekly, they are converging around those levels only. So we have still managed to close above these levels. That is also a good fact. On technical side, we have seen Nifty forming 3 white soldiers. It's a continuation pattern, a very strong bullish pattern. If the current levels are sustained, 10,750, we may see a move towards the level of 11,000, 11,050 for that matter. I would be negative, I would be bearish if we have a close below 10,650. As long as that does not happen, it would be a buy on this market for time being.
Okay, what about your strategies on the Nifty and the Bank Nifty, Gaurav? What are you suggesting?
For Bank Nifty, I would recommend buying one into towards level of 26,650 spot levels. Have a stop loss of 26,550 on the upside. 26,950 is what I would be looking at. I would not like to play with the options. I would wait for a dip for that. As far as Nifty is concerned, I would recommend selling a straddle 10,800 call and put combined, going somewhere around 225 or so. One can play for 150 kind of targets. 260 would be stop loss. The IVs are still too high. We are just 7-8 days away to the expiry, and for that, if you are having a 225 rupee premium, that gives you a good amount of traction for money to be made in next 3 to 4 trading sessions. So I think that can be a good strategy. As long as we don't see a strong breakout, I would not recommend buying a plain vanilla call or put for time being. Selling a straddle would make more sense.
Siddhartha, just wanted your view on the cement space. Now, news coming in that probably in the next GST meet, the GST rate on cement could be cut. And the important news that came in but a couple of days ago was the capacity expansion by ACC and Ambuja. Somehow, the sell side seems to like the move that, that after years and years, they are finally waking up and increasing capacity. But what's your view on ACC, Ambuja and cement as a space?
Yeah, so last quarter we had seen the entire cement pack reporting weak numbers and mainly impacting by the cost. So we have seen a lot of these companies, they have already they have been consistently adding capacities which have been impacting the realizations. Volume growth were high single digits for some companies or low double digits. So that was something which was encouraging. However, the cost side, the companies were unable to pass on the price hike. So that was what impacted the overall earnings for the cement companies in Q2. Having said that, if you see going forward, our view is that there would be a push on the infrastructure side, especially on the execution part before the elections, and that could continuously lead to a demand for cement, and we could see some price hikes. And now this news of GST rates, and if that comes down, that will definitely be a positive for the sector. If you come down to stock specifics, Ambuja, we have a neutral rating currently on the stock, while on ACC we have a buy rating with about 1770 target price. If you see some of the, so cement is more of a regional play. You will have to look at in which region the supply and demand dynamics, based on which the pricing power comes at. So there are so among the overall pack, we would believe our preferred picks in the overall cement pack would be JK Cement, which is Western based but has a mix of white cement. We like Dalmia Bharat, again eastern and southern player, and Ramco Cement, which is a south based cement player.
Okay, so that just hold on. Gaurav, what are the stocks that you're recommending for today?
The first recommendation would be buy on BEML. We have seen about 13% overaddition happening yesterday. Strong long positions getting built. Volume participation has been robust as well. It's on the verge of a strong breakout. If it manages to hold on the current levels of 785, 76, it can move even 10% from the current prices. But for timing, one can keep a stop loss of somewhere around 760, and on the upside targets of somewhere around 825-30 can be seen. Second, we buy on Infosys. Again, a strong breakout has been seen. Decent amount of addition has been observed. A breakout on hourly charts. One can keep a stop loss of 685 on the upside. 720, 725 would become quite possible. And the third recommendation would be sell on Kolpal. It's just reversed from the trendline resistance area, placed around 1310, 1315. As long as trading below these levels, there's a chance that it may again slip towards 1260, 1265 kind of levels. So using stop loss of 1320, one can sell it for target of 1270, 1260.
Okay, so it's a sell on Colgate. Am I right? Hearing that right, Gaurav?
Yes.
You believe it's topped out because it's trading at record highs. So just wanted a clarification on that. Okay, so it's a sell on Colgate. Now onto a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Yash Upadhyay is joining us right now. Yash, what's the stock on your radar?
Morning, Darshan, and the stock today is actually TCS with a negative call coming in based on the bearish engulfing indicator. Let's first try and understand what it is. It basically is formed at the top of a trend wherein the bullish candle is followed by a bearish candle with the body of the second candle completely engulfing the one ahead of it. The longer the size of the candle, the greater is the evidence of a top being formed. No further confirmation is required. Let's take a look back at the chart. As you could see over here, for the last several trading sessions, TCS has been consolidating around the mark of 2000, and on Thursday it saw a big drawdown. As you could see, the red candle over here that completely engulfs the one ahead of it, so indicating that there could be a potential weakness as far as the chart setup is concerned.
Okay, so we'll watch out for that, Yash. And if you do a historic comparison on how historical trend on how this strategy has performed every time this signal has come up, what would be the hit ratio?
Darshan, 6 out of the last 8 times that the indicator has turned negative, it has given you positive returns of 5% over the next 10 trading sessions.
Okay, thank you so much for that, Yash. Gaurav, before I move to Shrikant, any view on TCS? Are you seeing any similar negative patterns develop on your charts or on the FNO trends?
TCS has been trying to give a breakout above levels of 2020, 2022, but it has failed to do so. We have seen a bearish engulfing kind of pattern being formed yesterday. So there's a chance that we may see some more pressure. It's close below the 100 DM as well. For me, I would be short below levels of 1950. It has the immediate support of those levels. But as for timing, it would see some pressure and can slip towards the lower levels.
Okay, also joined by Shrikant Chouhan, Senior Vice President for Technical Research at Kotak Securities. Good morning, Shrikant. What's the setup like? What are you highlighting on the Nifty and the Bank Nifty?
Yeah, good morning, everybody. See, the way the Nifty is like spanning out, we are of the view that the Nifty is witnessing strong pullback after falling to the levels of 10,330, 340 levels. Here we are of the view that market is going to spend some time between the range of 10,750 and 10,850 or 900 on the higher side. And today specifically we are of the view that in case if we see any drop in the first half, then between 10,750, 720 we should look for adding long positions with a final stop loss at 10,680 on the downside. Again we can expect 10,850 and 10,900 on the higher side. Similarly we are equally bullish on Bank Nifty, and there also we should look for adding some long positions. And accordingly, like if there is any, broadly if there is any weakness, we should look for adding some long position.
Okay, strategies on the index, Shrikant?
See, indexed, I already mentioned that buying is advisable if there is any dip close to 750, 720. And stock specific, we are specifically bullish on cement companies, because yesterday there was like some activity when the market was closing. Ultratech Cement, SCC, they closed higher. We like Ultratech Cement, which closed around 3950 levels, and here we are of the view that it is heading for the levels of at least 4,084 to 4100 on the higher side. So with a similar target of 4100, 4120, we should look for adding long positions in Ultratech. Other stock which we like is from the IT space, and there we are bullish on Tech Mahindra. And here the stock has formed nice like bullish flag formation. So from here we are expecting stock to move towards 740, 745, and the stop loss level is very nearby. So 690, 692 should be the stop loss for any long position in Tech Mahindra.
Ultratech and Tech Mahindra are the stocks that Shrikant has recommended. Siddhartha, you said you were bullish on Maruti and you were telling your clients to accumulate it. What's the key driver? What's the rationale behind being bullish on it?
Yeah, so if you look at the stock price has corrected quite a lot, and obviously on the back of the volumes that have not been so encouraging this year. There are two factors to this. One is last year's high base, and to some extent this year's the impact of the increased insurance costs, the oil prices which had shot up, and a little bit on the consumer sentiments which were not so great towards the festive season. However, we see that the company is one of the best plays on the consumer side, especially if you see the four-wheelers that has seen consistent growth over a longer period. We believe next year could see the growth coming back for Maruti, and at the current valuations we believe that's an attractively valued stock from a one-year perspective. So we believe for investors looking at more from a one-year perspective should look at adding a stock when the stock is not doing well. A stock which was available at 10,000, almost more than 9,000, is now closer to around 7,000. So if you see our target price is around 8,500, and the current valuations of 20-22 times compared to the earlier valuations of about 24-25 times, that gives some comfort as well.
Okay, so that's the view that's coming in. Shrikant, what's your view on Indiabulls Housing? Was one of the top Nifty gainers yesterday. NBFCs made a comeback. Any view on Indiabulls Housing Finance? What should one do?
Yeah, see, like for Indiabulls Housing Finance, if we go through with its daily pattern, then very clearly the stock is forming some double bottom sort of formation, and yesterday the stock was up. But while looking at its overall formation on weekly and monthly basis, it looks like that it will take a lot of time to recover to important levels. So we are of the view that if there is any trading view, then only we should look for adding long position in Indiabulls Housing Finance. Currently it is at 775, and in case if we see any drop, then close to 760, 755, between these levels we should look for adding Indiabulls Housing Finance with a stop loss close to 745, and again we can expect close to 795 or 800 on the high side. So we are expecting stock to remain in a range 800 on the high side and 750, 745 on the downside is the area in which the stock will trade.
Okay, we just have 50 seconds for the markets to open. Gaurav, very quickly before the markets open, what's your view on Yes Bank?
Yesterday, we have seen a bearish angle forming on Yes Bank. We saw some amount of unwinding happening at the higher levels. 200 call option also has a very strong buy for me, it would be a negative for a time being. I would buy a put option because it's quite volatile based on news driven that has hit the media in the last couple of days. I would buy a 160 put option for that matter, but I would not short in the future.
Okay, so we have 25 seconds to go for the markets to open. We'll certainly watch out for some of the important stocks that will move in trade. Let's see how the Asian markets are panning out. There's no improvement as such as far as the Nikkei is concerned. It's down 1.7%. Shanghai is down. The SX Nifty, however, has come slightly better than what it was. It was down 65 points at one point of time. But nevertheless, we are bracing in for a weak opening. So the pre-market open sessions are over. Let's see what the Nifty is done at this point of time. It's opened absolutely flat as flat could be, so that's the traction that you're seeing on the Nifty. Ultratech Cement pre-open rate is indicating a 5% uptick, which looks surprising, but these are all pre-open rates. Grasim is doing well. Indian Oil has reacted positively to the buyback news that has come out. Bharti Infratel has managed to move up. Yes Bank has managed to move up. Cipla has managed to move up. That's what I'm seeing. On the negative side, the weakness continues in UPL. I'm seeing that down by almost 1.5%. I think it's Bajaj Finserv is showing me a 5% downtick. I think that will settle down as trade settles, but that's the traction we are seeing. And let me see if I can pull up something on the mid-cap end of the market to see what exactly is happening there. So just hold on and I will get some mid-cap movers. Eveready Industries is up 10%. That's what I'm seeing at this point of time. The other counter is UCO Bank has managed to inch up much higher, but these are all on very small volumes. PC Jewelers continues its good run. It's up almost 7% in today's trade. Rain Industries has managed to move up after having a very weak session. And on the losing end, you have M&M Financial, you have Hindustan Zinc, and you have Kaveri Seeds, which is down in today's trade, which is up 3%. So I'll ask, I guess, Gaurav, any view on Kaveri Seeds? Yesterday, a big spike came in the closing moments of trade. Is that a sign of a breakout? What should you look at?
It already gave a breakout of levels of 580, and what I would suggest is if you get any dip towards level of 585, 580, that would be a good level to go long into. And on the upside, it can test levels of 625, 630. There was a lot of discount in the futures segment. So if somebody wants to play, stick to only cash for time being. And for targets of 625, one can buy on a small dip towards 585.
Siddhartha, we've seen that PSU stocks of late, especially the PSU banking lot, has actually started to show traction post the new RBI governor that came out. What are you advising your clients to do with PSU banks? Valuations are at record lows. Is it worth accumulating all these stocks? And if yes, which are the top picks there?
Yeah, Neeraj, so if you look at our overall thought process on the banking space, we believe that the corporate lenders could benefit, are likely to benefit in the current environment and should do well in the next 1 or 2 years. And that is where our preference has been. So coming specifically to PSU banks, yes, there is a change in the guard at RBI, and the market is expecting that there could be some relaxation in the PCA norms as well as some other window for the PSU banks. The market may also be expecting some fresh recapitalization of these PSUs. However, these all remain mostly news driven and could be at best trading opportunities at the current in the current market. Our preference continues to be on the larger side, so the only stock that I can look from the PSU right now is an SBI, which is on the corporate lending side and one of the largest. Doesn't have that much of asset quality issues as well as the capital issues. So that's one stock that one can look at from the PSU space.
Okay, Indian Oil has managed to inch up almost 3%. Is one of the top gainers on the Nifty. Shrikant, Indian Oil or any of the oil marketing companies, would you venture a buy in any of them?
See, like we like IOC as well as Bharat Petro, BPCL based on charts, because the way they are like recovering from their lows, we are of the view that they have seen their worst. At the same time, if you just go through with its weekly pattern, then there is very clearly the stock is forming some double bottom or higher bottom kind of reversal. So 145, 146 is the next level to watch out for, and in fact they have announced buyback at 149. So broadly we are of the view that the stock is going to spend time in a range, and that should be between 130 and 150 on the high side. For BPCL, our view is that it is most like outperforming in this space, and yesterday the stock was very close to its breakout level. So above 335, we are expecting stock to move towards 355 or 357. So it is decent upside that we can expect from current levels. On the downside, yes, the levels of 320, 325 acting as a very good support, and with the same stop loss, we should look for adding positional bets in BPCL because the way the crude is moving and the crude is volatile, it is going to take time all these stocks to come out of their important levels. So 355 is the target with which we can trade in BPCL, and for IOC 149 to 150.
Gaurav, Reliance at 1100, worth a buy?
It's stuck in the range. I would wait for a dip towards 1060, 1070. Thing is that there's a lot of OI addition at 1000 put option, 200 DM is placed on those levels. It has bounced back from those levels. Downward sloping trend line resistance at 1150, 1160. So one can buy on 1080, stop loss of 1060. On the upside, 1140, 1145 can be expected. Stuck in the range, so play very accordingly.
Surprisingly, UPL managed to rally over the past few days on farm loan waiver news, but the last 2 or 3 days have been rather weak for them. Yesterday it fell in trade. Today also the pre-open session indicates that it will open gap down. What's the chart reading and the FNO reading on UPL, Gaurav?
For UPL, there's a strong resistance at levels of 780, and we have not seen aggressive long positions getting built. Actually, we saw a good bounce back coming in last couple of weeks, but that has not translated in very aggressive long positions getting built. For me, it would be a sell as long as we are trading below levels of 800, 805. As far as charts are concerned, it had formed a bearish ABCD pattern, harmonic pattern. It gave a break, the targets for that as well. For me, it's an avoid for the time being. One can either buy a put option, buy on the long side, buy only if it manages to hold above 800, else it can be quite risky bet as if you are going long in the name.
Siddhartha, we spoke about earlier the agri theme and you named some stocks. Let's get more specific in terms of how you see this playing out, because the farm loan waiver is something that both the BJP and Congress have spoken about. I believe you spoke about counters like Escorts and M&M. Which other stocks are you pushing out as far as the agri theme is concerned?
Yeah, so Neeraj, that is a possibility that that may happen. There is a rhetoric that after the elections, while some of these states have seen this as one of the key demands, and one of the winning parties had promised of a farm loan waiver, we have also seen news reports that the centre may also look at giving out some figures like 4 lakh crores of farm loan waivers. So definitely companies which will benefit from them are the rural agri related stocks. One is obviously the names that we took of M&M and Escorts, which are a direct play on the rural theme. Then you have a lot of these rural related finance companies like M&M Finance, the Sriram Transport Finance kind of companies, which would tend to benefit from which should benefit from any of these developments. In the agri space, if you see, while I don't have many names, UPL is one of the names that we cover. We have a buy rating there with a target price of 924. That could also be a key beneficiary in that space if you look from a pure agri theme.
What about the two-wheelers, Siddhartha? What's your play there? Of late, they have all been seeing traction after the big meltdown that we saw in them. What are you all recommending your clients on two-wheelers?
Yeah, so the two-wheeler space have seen quite some, the growth have tapered off in the from the peaks, and even the valuations have. We have seen a change in strategy, especially from Bajaj Auto, where it is targeting more of a market share gains compared to its and is willing to let go of margins, because of which it is likely to see a subdued FY19. Nonetheless, based on valuations, we prefer a Bajaj Auto over a Hero Moto. We have a buy rating on Bajaj, while we have a neutral rating on Hero Moto. We believe the Bajaj is well placed given the valuations, given the balance sheet, given the models, and the strategy should work out well for Bajaj next year. Although this year they could see subdued numbers, we believe that could be a play in the two-wheeler space.
Okay, surprisingly, the pre-open rates have settled. The Nifty is down just 7 points at this point of time, and the Nifty Bank is down just 5 points. So the traction doesn't seem to be too much on the negative side. Surprisingly, pull up Syngene. It's showing me a downtick of 10% at this point of time. I'm not sure what the news in Syngene is, but it's down 50 rupees. That's what I'm seeing. The other drags include a Dabur, a Dilip Buildcon, and HCL Technologies is down, M&M Financial is down in trade. So that's the traction that I'm looking at. PC Jewelers continues to rise. It's up another 4%. Cement as a theme is doing extremely well. Among the top gainers in the Nifty 500, you have an Heidelberg Cement, you have an India Cement, you have a JK Lakshmi Cement, you have an Ultratech Cement, you have an Ambuja Cement. So all the cement counters are up anywhere between 2 to 3%. Shrikant, which is the best cement play at this point of time?
See, we like Ultratech Cement as well as ACC, and in our today's strategy we have given buy on Ultratech. But while looking at the overall formation of this particular sector, we are of the view that it is like moving up with good volume and price retracements as well as price expansion. So one thing is very clear, that at every decline buying is coming in this particular sector and they are reversing back. In fact, along with this, infra companies and capital goods companies are also supporting to this particular sector. So we are specifically bullish on cement as well as capital goods and infra related companies. We like ACC along with Ultratech. Ultratech already we have given buy call at 3950, and for ACC we are of the view that it is very close to its important resistance area of 1530, 1535, and above that we can expect a strong breakout, price breakout in the stock. So from here certainly we should look for adding long positions with a stop loss at 1470, and we can expect 1570 or 75 on the higher side. So okay. ACC looks good.
Okay, ACC, we're just minutes away from the market opening, and we'll tell you all that you need to know to stay ahead in trade today. First of all, Motherson Sumi is up, is up in stage, given the fact that Reuters reports of a merger of the German ancillary company Leoni, according to Reuters, will merge with Motherson Sumi. Cement stocks will be in focus as the GST Council may look to rationalize the 28% slab, and taxes on cement may be cut as per an ET report. IOC to buy back 3% of the total equity at 149 rupees per share at a premium of 9%, and the company will also pay an interim dividend of 6.75 per share, implying a dividend yield of 5%. In key brokerages, Citi initiates coverage on United Breweries with a buy rating and a target price of 1550, implying a potential upside of 23%. JSW Steel says that the capacity expansion to 13 million tons per annum is on schedule for commissioning by March 2020. And Indian Energy Exchange Board will meet on December 20 to consider the buyback proposal. We have close to 2 minutes to open. Siddhartha, just a word on United Breweries. Are you all tracking it, and what's the view going ahead?
Yeah, Neeraj, so that's a space that we have been liking for quite some time. Both United Spirits and United Breweries are something that we like. However, at current valuations, we have a neutral rating on United Spirits, but we do have a positive view on United Breweries with a target price of 1520. If you see the entire growth story revolving around the breweries, the company getting into newer segments and newer geographies, that is helping them in the overall growth space. So that is something that is very exciting, and that is why we are liking United Breweries from a long-term perspective.
Yes, Siddharth, thank you so much for taking the time out and joining us on Bloomberg Quint. Okay, 1 minute to go. Gaurav, very quickly, as per what you're seeing on the charts, what's your top opening pick? Gaurav, I think we've lost him on Skype. Siddhartha, I'm sorry, Shrikant, that's for you. Can you just take what's the top pick that you're seeing as per opening?
See, along with Ultratech, I would like to go with Tech Mahindra, which is at 709, and it is very close to its breakout level. Stop loss level is also nearby. So at current levels, we should look for adding Tech Mahindra to our portfolio. Again, we can expect 735 to 745 on the high side.
Okay, Gaurav, just seeing the pre-market opens, what's your topic?
It would be Infosys with the kind of portion that we've seen getting built in the breakout. One can keep a stop of 685 on the upside, 720, 725 would be the target to look out for.
Okay, just 14 seconds for the markets to open, and there we can see traction, what exactly is happening. The Nifty is not indicating a major downtick, but we'll see what exactly happens as far as our markets are concerned. So the market is open. Let's see, the Nifty is down just 6 points. The Sensex is down 40 points. Now the cuts have started to come in on the Nifty. The Nifty Bank is down by 45 points. So traction is there, but the cuts now on 30 points on the Nifty. What is the mid cap is flat in trade, not too much. In fact, the small cap index has opened with a slight positive bias. What are we seeing on the Nifty? IOC continues to rule the roost. Came out with a buyback and a dividend. It's up almost 3% in trade. Cement as a package doing well. Ultratech is the only cement counter in the Nifty, and that's why it's seeing traction. Grasim is up almost 1.8%. The banks are contributing, ICICI Bank and HDFC, but as we speak, the red on the screen is getting much higher. Yes Bank is down almost 2%. HCL Tech is down 2%. ONGC, Hero, Indiabulls Housing Finance gives up some of the gains of yesterday. Reliance has not been able to hold on to the 1100 mark in trade. So traction is clearly there on the negative side. The advanced decline is almost 1:5 on the side of the negative side. So the traction is not good at this point of time. Let me take a look at some of the mid caps that have managed to move in trade currently and that are performing in trade. First of all, Heidelberg Cement, yes, so pull up cement counters. Heidelberg is up 5%. JK Lakshmi is up 4%. Pull up ACC, pull up Ambuja, pull up India Cements. So cement, because of the news of a potential cut in GST, is seeing a lot of positive traction in trade today. You have PC Jewelers, which continues its good run. It's up almost 5% in today's trade. Motherson Sumi, the market takes the news of a potential acquisition on the positive side. It's up in today's trade. Apart from it, the other one is some of the PSU banks. There is Corporation Bank, there is UCO Bank. All these counters have managed to inch up in trade. What is not doing well? Rain Industries is not doing well. Ujjivan Financial gives up some of the gains that it had yesterday. And Yes Bank continues to bleed from what happened in trade yesterday. What we are seeing as some of the prime stocks are concerned, Yes Bank continues to bleed. Titan has now moved into the positive, and the other counters, surprisingly, Syngene is down 1%. It's actually recovered some of the losses that it showed in opening trade. That has recovered. Reliance is moving to the lowest point of the day, and Infosys is moved to the highest point of the day. So that's the traction that we're seeing in as of now. But let's get in a fundamental voice. Pradip Shah, chairman at IndAsia Fund Advisor, joins us on the show. Good morning, Pradip. Most of the news is out. The election verdict is out. The RBI news is out. What is it that you are advising clients now? What should they do?
Well, I think there was disruption at the RBI, and there was much worse performance by the BJP, I think, which went against the market's thinking. But the market had been anticipating something of this sort, because if you remember, on August 29, 2018, it was over 38,000, and the index was over 38,000, and it fell 10%. And then when the election results came out, the facts were confirmed, the SIP loaded mutual funds were waiting in the wings, and they've been buying. And partly because of the RBI disruption, it started after the RBI announcement. The next day it started at a lower level, but they recognized that the new governor who would come in would possibly be more forgiving of NBFCs and would start improving the liquidity in the system, which would help the economy. And that's what I think the new governor has said, that he's going to have a dialogue, which is very important, and he's going to look at the issues that the market is facing. So I think overall the market has received the new governor very positively, and of course it has digested the election results. That's why we've seen a little run up in the market. However, the outlook doesn't seem as sanguine as the market seems to think.
Are you deploying money in the market at this point of time, or are you holding on to cash?
I think I would like to hold on for a little more time. I think there will be buying opportunities because clearly the election results of the three Hindi-speaking states were negative for the BJP. While in the past, in 2003, 2004, and so on, those results did not get reflected in the central elections, and this time also it may not result in any effect on the central election. Nevertheless, there is a caution that is advised. If, for instance, a coalition government comes in at the center, if, for instance, the BJP completely loses and a rag-bag of coalition with no proper leader comes in, it'll be even worse than imaginable. So that overhang plus the global overhang, the global scene is not that good. There is a slowdown. The IMF has acknowledged that there is a slowdown and reduced its growth forecast for 2019. Oil, while it has come down in price, it's also signaled that there's a slowdown anticipated. The US market, last week, for instance, the US bond yields, 10-year bond yields, 2-year, 5-year bond yields, the German bond yields all ran up at the same time. Why? Because people were pulling money out of equities and putting them into long-term bonds to be safe. At least the principal would be protected and some returns would be given. Because they expect that the earnings growth in the United States, for instance, will not be the same as last year. Last year was this year, that is 2018. The earnings have been boosted by the tax cuts. The same kind of growth cannot continue. Even if the economy is growing, the growth has anyway been anticipated to slow down to 2.7% for the US economy, from against 3.5% and 4%. So that itself will cause some problems. And the trade wars between China and United States are having a telling effect on the market. So all that does not augur well for us. Luckily, things do resolve themselves. Now the Brexit thing, at least Mrs. May has not lost her job. There's a dialogue going on. Something good might come out of it. Something good might come out of the China-US wars, in which case the markets will have cause for improvement. And again, if we see the BJP coming back to power or a stable government coming to power in 2019, that would be very good news for the market, because underlying the economy has the strengths and resilience to overcome, for instance, last year's drought. Lots of changes have been made and those will augur well for growth in the future. And with a good positive government which is stable, a lot more action can be taken to fuel growth.
Well, you think I think one of the biggest issues of late has been the issue with the NBFCs and the way they've corrected. You think it's overdone and you feel that there could be more potential downside?
There is potential downside, but now with a change of governors and the governor's brief statement where he has talked that he has said that he wants to have take everyone with him, as it were, listen to views and so on. And you noticed yesterday he had a first round of meetings with the public sector bank chairman, who have advocated that this PCA, the prompt corrective action, should be relaxed for these 11 public sector banks, which had 18% of the loan book. Now, if that relaxation takes place, money will again flow to NBFCs. Again, if the directive or perceived directive of the RBI to banks, one deputy governor had talked about it in one of his interviews in the last 2 months, saying that NBFCs should look at other means of financing also. But if that is relaxed and so banks continue to lend money to NBFCs, then the lubricant of the economy, money, through NBFCs, through banks, will improve, and that will lead to demand improvement. We've already seen in November automotive sales slow down, partly because of constraints on financing. Housing sales also are affected by slowdown in lending. So if those pick up, then the economy gets some momentum again.
What about, where should money be put now? Which are the stocks and themes that look attractive to you valuation-wise?
So, taking a 3-4 year perspective, a longer term perspective for equities, you can see that Indian pharma industry, IT industry, some of the engineering, and of course the consumer facing industries will continue to do well. Now, whether one should buy a consumer facing industry at a 50 or 70 multiple, that's a different question. That is not something to be taken lightly, because valuations of our consumer-facing companies are very high relative to what can be justified on the basis of growth or so. So, but there is money and there's confidence in those companies, and so people will keep holding them. There's no basic seller. Even if the market goes down a little bit, they will not sell. So that, and the floating stock is typically limited in some of these companies, and so they hold up in price. But whether they are justified for someone who wants outperformance, it's very difficult to say. I would say I am very hesitant in recommending high multiple companies. I prefer value stocks, and in the industrial sector, and we've seen this rally partly was because some of these companies were beaten down so badly, especially the smaller companies, relatively, not the nifty kind of companies. They were beaten down because there was perception that the election results and of course this tense standoff between government and RBI would be detrimental to the smaller companies. Now that part of that uncertainty is over, and so value stocks have been picked up by the markets. So that kind of opportunity will continue. Individual stock picking in across sectors, not necessarily limited to any sector. And within the sectors, of course, we see opportunities in the pharma sector, I feel, because there's continuing growth, demand, opportunity to address world markets. We see opportunities in the IT sector. Again, Indian companies are doing very well. You saw the HCL acquisition of the IBM product company. So they are moving from a pure service play to more product and solutions companies and total solutions, so that they have domain understanding and offer a complete IP-led solution as well as their own service offerings. So these sectors, I think, will continue to do well in the foreseeable future.
About two-wheelers, of late, most of them have corrected significantly, but recently we are seeing some bit of bounce back by them. Obviously, the rural theme, the farm loan waivers, all of them bore well for two-wheelers. Are you bullish on the two-wheeler space as such?
I think so. There is no substitute for personal mobility. Our public transportation systems will take a long time to catch up. Government is trying to do a lot through the metro systems and so on, but it's not enough. And the last mile connectivity, people need two-wheelers, or like one of the companies has come out with a small, more affordable car, which would be a substitute for three-wheelers. So those products have to do well. Now, when there was a slowdown in money that is needed to buy those cars, the loans that are needed to buy these vehicles, two-wheelers and four-wheelers and so on, obviously there was a slowdown in the market. Now the prospect looks better, and I think you will see a revival in demand, because at the end of the day, people need that service, that product to a personal transport vehicle.
Which are the sectors that you would strictly avoid at this point of time?
Well, to avoid, those which are politically sensitive sectors, I think one has to worry about. Though this government is very conscious that they do not want to be seen to be giving sops for elections. But we've seen in the states where they were ruling, they gave away loans. There were loan waivers and so on. Now, loan waivers, the state does provide the funding to the banks, but it provides after a lag. The banks have to struggle for getting the money and so on. So where there is potential for intervention by the government through either regulatory change or through directed decisions, that certainly worries me. Now, in the banks, I think the government is very conscious that they should stay hands-off. The RBI is doing a great job, and banks have been recapitalized. So hopefully this time they will stay off. But otherwise, banks would have been worrisome for me. So now at this time, I would only, power sector or some of those sectors where undue regulation can affect government, especially those related to the distressed economies, such as the farm sector economy. So where there is power is one of them, but water, now today they've charged, they are putting a price on groundwater. Now these regulatory, you don't know where they will come from. So some of them, these will have effect on individual companies. But and some who are close to government or perceived to be close to government may be individually affected, because if a new government comes in or a changed philosophy comes in. But otherwise, generally the economy will do well if there is stable government and that's what one must focus on, whether we will have a politically stable government and the global outlook. If the global outlook continues to be dim, then of course we will be affected. We cannot be insulated. But if the trade war between China and United States eases up, yes, that will be good for the economy.
Okay, Pradip, thank you so much for joining us and sharing your perspective with us on Bloomberg Quint.
Pleasure.
Okay, that was Pradip Shah. But on the other side of the break, a very special conversation with Saugata Gupta of Marico on the long-term outlook for the FMCG sector.